Dividend income is one of the income that we receive for being the owners of the company. We have seen companies declaring dividends, which is nothing but sharing of profits to the owners of the company. So how do you receive the dividend income? Cash or credited to your bank account, right? So what if a company decides to distribute its assets as dividend instead of cash? How should the company account for it? So welcome you all to our today's discussion on IND AS 10 Appendix A, distribution of non-cash assets to the owners. Under Indian GAAP, there is no specific standard which deals with the distribution of non-cash assets to the owners. However, under IND AS, this aspect is dealt with under Appendix A to IND AS 10 on the subject distribution of non-cash assets to the owners. So, to whom this IND AS 10 Appendix A is applicable? So, it applies to the following types of non-reciprocal distribution of assets. Please note this word non-reciprocal distributions. What do you mean by non-reciprocal distributions? It means that this Appendix A is not applicable to exchange transactions. For example, when a company enters into a sale agreement with a shareholder for the sale of an asset, this means that the company is giving the asset for an amount in return. So, if something is given in exchange for the distribution of these assets, then this appendix should not be used. So, it should be used only in cases where the company distributes the assets to the owners of the company, that is the shareholders, and nothing in return is obtained from them. Only in such cases, this Appendix A can be used for accounting by the entity which is distributing the assets. So, let us come to the applicability. Appendix A to IND AS 10 applies to the following types of non-reciprocal distributions of assets. Assets can be anything. It can be a fixed asset, it can be an investment, etc. So, distributions, non-reciprocal distributions of assets by an entity to its owners acting in their capacity as owners. So, what are the two things which are given here? Distribution of non-cash assets. So, either it can be a non-cash asset or distribution that gives owners a choice of receiving either a non-cash or a cash alternative. So, the company is giving an alternative to the shareholders. If they want to receive it as a non-cash asset, they can do it. Else, there is also another option which is available to the shareholder. So, these two options are given to the shareholders. Then in such cases also, this Appendix A to be applied. So, it applies to all the distributions in which all owners of the same class of equity instruments are treated equally. So, let us understand what is meant by all owners of the same class of equity instruments are treated equally. Take an example. A Limited is a company which is controlled by public at large. No single individual has power to control the entity, or no group of shareholder is bound by a contractual agreement to act together to control the entity. If A Limited distributes its fixed assets or any other asset among the shareholders on a proportionate basis, then this appendix is applicable. So, which means all the shareholders are treated equally. There is no specific set of shareholders who control the entity. So, in such cases, this appendix will not be applicable. So, let us move to the non-applicability part of this section. So, this will not be applicable to a distribution of non-cash asset that is ultimately controlled by the same party or parties before or after the distribution. So, before the distribution also, it is controlled by the same party. After the distribution also, this non-cash asset is going to be held by the same party. So, in such a case, there is no accounting which is required, right? So, in such cases, Appendix A should not be used. The above exclusion, this exclusion which I just told, will be applicable to all the separate, individual and consolidated financial statements of an entity that makes the distribution. So, this appendix also will not be applicable when an entity distributes some of its ownership interests in a subsidiary but retains control of the subsidiary. Suppose say A Limited is having 100% equity stake of B Limited, which is a wholly owned subsidiary of A Limited. So, if it plans to distribute some of its ownership stake to the shareholders of the company without receiving anything in return, but ultimately chooses to retain the control of the subsidiary, then in such cases also this Appendix A should not be applied. The entity making a distribution that results in the entity recognizing a non-controlling interest in its subsidiary accounts for the distribution should be accounted for in accordance with IND AS 27. Okay, let us move to the definition of control. So we have been talking about control for this non-applicability. So let us understand quickly what is the definition of control as per IND AS 103. Paragraph B2 of IND AS 103 states that a group of individuals shall be regarded as controlling an entity. So when do we regard that? When, as a result of contractual arrangements, means that they enter into a contract. They collectively have the power to govern its financial and operating policies so as to obtain the benefits from its activities. So when do we say that some people have control over the entity? So when a group of people or an individual is entering into a contractual arrangement for making it very clear that they will only have the power to make the financial operating decisions of the entity. So this means that these people have control over this entity. So why do they do this? This is because they wanted to obtain the benefits from these activities of the entity. So this is when we say that an entity is controlled by a group of individuals. So let us move ahead with the recognition part of this distribution. We will call this distribution as dividend. Why? Because this is also a distribution to the owners of the company like dividend. So we will call it as a dividend distribution. So to whom this IND AS Appendix A is applicable? So this appendix will address only the accounting by an entity that makes the non-cash asset distribution. So please note, this does not address the accounting by the shareholders who receive the distribution. It is only for the entity making the distribution. So when will you recognize a dividend payable? So the liability to pay dividend shall be recognized when the dividend is appropriately authorized and is no longer at the discretion of the entity. So it can be the date when declaration of the dividend is requiring any approval from the shareholders, if so, or it can be the date when the dividend is actually declared. So when will you recognize the dividend? When actually the liability to pay dividend shall be authorized and is no longer at the discretion of the entity. So it can be the date when the dividend is actually declared. So how will you measure the dividend payable? So actually the dividend will be measured. Generally we will distribute dividend in the form of cash. So in such cases there will not be a problem. But in the current case we are distributing assets and this is going to be accounted as a dividend. So how will you measure the dividend payable? So an entity shall measure the liability of dividend at the fair value of the assets distributed. So if you are distributing a fixed asset, then the fair value of the fixed asset will be the dividend payable amount that you will recognize as a liability in the books of the entity making the distribution. So there was another option, that an entity giving a choice of cash alternative or non-cash asset. So in such a case, how will you measure the dividend payable? So if an entity gives its owners a choice of receiving cash or non-cash asset, then the entity shall estimate the dividend payable by considering both the fair value of each alternative. So how will you consider the fair value of each alternative? So suppose say there is a 50% chance that shareholders would opt for non-cash asset and another 50% chance that shareholders will opt for the cash alternative. So in such a case, fair value of each alternative with the associated probabilities should be estimated and this should be accounted as the dividend payable. So I repeat once again, if an entity gives its owners a choice of receiving cash or non-cash asset, then in such cases, the measurement of dividend payable will be done by considering both the fair value of each alternative along with the associated probabilities of owners selecting the alternative. So this probability should be estimated from the entity's angle. So also at the end of each reporting period and at the date of settlement, the entity shall review the amount payable and adjust the dividend payable amount. So every reporting period end, the fair value would have changed. So you should adjust the dividend payable to this extent. So at the end of each reporting period and also at the date of settlement. So settlement date will have a different amount. So on both these dates, the entity shall review the amount payable and it should adjust the dividend payable amount. When an entity settles the dividend payable, it shall recognize the difference, if any, between the carrying amount of the assets distributed and the carrying amount of the dividend payable in profit or loss. So suppose say the fair value of the asset is 150 at the date of settlement, but the carrying value of the asset is only 100 in my books. So this 50 amount of rupees 50 will go to my profit or loss account. Let us understand the series of entries to be passed. So on the date of declaration of dividend, how will you recognize the liability? So the entry will be retained earnings debit to dividend payable for the fair value of the asset which is distributed. So let us suppose say the asset to be distributed is fixed assets and the fair value is 130 rupees as at that date. So the entry will be for rupees 130. On each and every reporting period and date, you should review or the entity should review the changes in fair value. Suppose say the fair value has increased by rupees 20. So these changes are to be incorporated for the liability also. So the entry will be retained earnings debit to dividend payable to the extent of change which is rupees 20 here. Finally, on the date of settlement, what is the entry that you will pass? You will exhaust this liability, dividend payable debit, and you are transferring this fixed asset. So two fixed assets. But the value of fixed assets in your books is only rupees 100. However, what you have recognized in your dividend payable is rupees 150. So this difference will go to your profit and loss account. So we here come to the end of our break time. Please post your comments in the comment box below or get in touch with me for any other doubts. Hoping to see you all soon in the next session. Thank you all for your patient listening. Thank you and bye from Radha.